Round tripping is a phenomenon that really started quite a few years ago in Nigeria, but obviously it only comes about when we have the situation we have right now, where there's a huge premium between the parallel market rate and the official market rate. Joining me in the studio to take a look at this whole phenomenon and the threat it poses to the Nigerian financial market is Bismarck Rewane, CEO at Financial Derivatives. Thanks a lot, Bismarck, for joining us on the show today.
Good afternoon, Wole.
Well, first of all, like I mentioned, this is something that we've seen in the past. And
yes.
Many people allegedly made a lot of money, especially in the late 90s, with this whole phenomenon of the official market rate being divergent from the parallel market rate. But give us a sense of what we're seeing right now and your thoughts on this situation. The phenomenon right now is that there's a 10% premium on the parallel market compared to the official market rate.
Actually about 14%. But the reality is that this is aberrational. In the past, it was actually institutionalized because the markets were pretty rigid. Now it's aberrational. There's an opportunity for regulatory arbitrage, which is taking place just because the BDC limits were reduced. So it's exaggerating the trend. And I think it will correct itself because the central bank will have to do something to correct this situation.
Indeed, like you mentioned, is this whole phenomenon of BDC regulating supply to the BDCs that banks can make available to bureau de changes in Nigeria. And it all just brings up this whole question of the CBN's policy with regards to the exchange rate. Over the last year or so, we've seen different measures taken to try and stem demand in the official market. What's your thoughts on the overall CBN's policy?
Well, I think the strategy of the central bank is what I call broken into three broad objectives. One is to smoothen out the volatility in the exchange rate. Two is to reduce the differential between the parallel market and the official market, basically desegmenting the market. And thirdly is to find a real equilibrium exchange rate. So these three objectives can work in a reinforced manner, but they can also work in a dysfunctional manner. But occasionally it happens when it works in a dysfunctional manner. What happened in the last 2-3 weeks is one, the removal of the restriction on capital inflows, which actually increased the amount of dollars coming to the market. Two, we saw the naira appreciate in the official market. Then three, it was a question of reducing the limits on the bureau de changes from $500,000 to $250,000. That sent a signal to the traders that there was an opportunity for regulatory arbitrage. They've taken advantage of that, pushed the market all the way to 168, 169. It has come all the way down to 163, 164 against the dollar. At a time when the dollar was actually weakening against other currencies. So against the basket of currencies, the naira has actually weakened somewhat in the parallel market. But the question is, who leads and who follows? In a price discriminating monopoly situation, the parallel market constitutes only about 10, maximum 15% of the total market. That cannot be leading the official market. The official market is 85% of the total market. So what the policy should establish or re-establish the central bank and the official market as the price leader in this current situation. How do you do that? You set the broad objectives over the 2-3 year period on how to unify the exchange rates. In the short run, remove all aberrational policies that will create fear and panic amongst traders. Therefore, restore the limit of 250 back to 500. If you like, make it 1 million. What will happen? The parallel market will crash even below, in the short run, below the official rate. So we'll have some kind of unification of rates. That will be good for the currency. Right now, the fear in the parallel market is beginning to affect the official market. And because there's a round-tripping profit to be made, some people are now looking for ways and means to start carrying out that kind of what we call parasitic relationship.
But practically, what do you think that we can actually unify these rates in Nigerian context? Because, and the reason I say so is because we know the big issues with Nigeria. We import so much. So central bank obviously can never leave that exchange rate to the forces of demand and supply totally, simply because of the inflationary impact that any major currency weakness can have on naira.
No exchange rate is left totally to the market. That is given. You intervene. The frequency and volume of intervention depends on how far away you are from equilibrium. As far as the currency is far away from equilibrium, you need to intervene. And intervention is an exercise in futility. The Nigerian economy is like any other economy. Russia, India, all of these countries have gone through this whole process. You will get there sooner or later. First and foremost, you would liberalize the current accounts. Then you will liberalize the capital accounts. Then you will get a unified exchange rate. You will sign the Article 8 of IMF Heads of Agreement, and you will have a convertible currency. There are three types of currencies: the reserve currencies, convertible currencies, and exotic currencies. Right now, we are an exotic currency. So we have to move to become more of a convertible currency.
And of course, we have MPC tomorrow. Decision will be made. Obviously, there will be some discussion around the exchange rate. Do you expect any policy changes, given what has happened over the last 2 to 3 weeks?
No, I don't. Look, I'm one of the few that says that the central bank should leave the interest rate unchanged. They've tightened significantly. We've seen inflation increase. We've seen it drop a little bit, not a little bit, dropped sharply, but the trend is what is important. This drop could be a blip, or it could be the beginning of a trend in what direction which we want to see. But I think we'll wait a little bit, wait for 1 more month. The last time we raised was May. We'll wait for 1 more month and then see what happens. On the other hand, some people say there's a minimum wage, there's a huge amount of FAC, there's diesel, there's this, there's all of that. So why don't you be preemptive and proactive? That's the school of thought. I like to be a fly on the wall in the MPC meeting, but I'm sure the guys, they are smart enough. They're very clever, and I'm sure they'll come up with what is best for Nigeria.
Well, the market certainly hopes so. But what about on the exchange rate policy? I think that's where I'm
well, the interest rate,
because obviously it goes beyond interest rates.
The stronger the interest rate, the stronger your currency. Because once the interest rates tighten, inflation, the incentive to consume is reduced, because that which is not consumed is saved. Once the savings increase, then inflation begins to get tamed. In Nigeria, there are 2 drivers of inflation in the last 3 months. 3 drivers, actually. 1, the harvest. 2, the price of diesel. And 3, the exchange rate. The price of diesel is stopped going up. It started coming down a little bit. The exchange rate, if it appreciates, you can probably tame inflation. Then the question of money supply becomes another issue. So the central bank has more tools than just interest rates to control money supply. They can mop up, they can increase the reserves, they have a multiplicity of tools. Right. And I'm sure they will weigh all the options. Right now, all options are on the table. Some anticipatory, some reactionary.
All right.
We'll see. Okay?
All right. Okay, thank you so much for your thoughts. Speaking to Bismarck Rewane, giving us his thoughts on the CBN's exchange rate policy and, of course, the whole phenomenon of round-tripping in Nigeria. It's back to you, Lorato.